Welcome, I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia. Tonight's presentation is on how to invest as a returned American expat. So of course, no presentation is complete without first noting that this is not personal advice, this is general information. I only provide advice for clients, and so you'd be well advised to seek your own counsel or financial planner before taking action on anything that is discussed here. Do note that following the presentation, we always upload the presentations to our YouTube channel. You can go there. Feel free to subscribe to be notified of future presentations when they become available. And you'll see there's a whole host of other webinars that have been given there previously. So a little bit about me, for those who aren't familiar. I'm a tri-citizen, born in the UK, raised in Australia, and spent 16 years in the US. I've been a financial planner now for more than a decade and focused on the needs of Australian American expats. So Australians in America, Americans in Australia, and I'm a frequent conference speaker and thought leader in the world of international and cross-border planning. Some examples of the kinds of clients we work with, you can see right here, but let's get into today's presentation. So we're going to be looking at a couple of things and being clear. Apparently the title was ambiguous, just judging by some feedback we got from Facebook. I apologize for that. Really, this is a presentation pitched at individuals that are US tax residents, and we'll talk about that. And it's a troublesome term because the term in itself requires some definition before understanding whom this particular topic is relevant to. So first, we're going to look at how your US legal and tax residency status changes your investment choices, why that happens, what's one particular pitfall that we need to be mindful of, the Passive Foreign Investment Corporation rule that came about from the 1986 Tax Act. We'll look at some relative strengths and weaknesses of investing in Australia versus the US, what opening a brokerage account from overseas looks like, or maintaining a brokerage account from overseas involves, and some risks there. Approaches to investing, we'll just briefly touch on that before looking at specifics of investing and how one goes about doing that, managing their global portfolio from abroad in a different currency, and then some implications to do with foreign exchange. All right, let's do it. So first, we're going to start with definitions of tax residency. One thing I'm very clear to explain in the Global Financial Planning Institute class that I run, teaching financial advisors about these things, is that there's three different kinds of residency we need to be mindful of. They all sound the same. You say, oh, where are you a resident of? People mean, where do you live is typically what's meant by that. But when dealing in the world of tax, immigration, and financial planning, we need to be very precise. So there's three definitions. There's your legal residency. Are you here on a visa? Are you a citizen? Whatever the case may be. What's your legal status in a particular country? What's your tax status? That can be different again. So if, for instance, an Aussie living in the US returned to Australia for a month just on a holiday, was not conducting business, nothing else going on, would they become an Australian tax resident? Almost certainly not. They would remain a US tax resident, but if there's other facts and circumstances, and there are tiebreaker provisions, because you can only be a primary tax resident of one country in a given year, there are tiebreaker provisions to determine where that tax residency actually lies. The third definition of residency is for estate tax purposes, less relevant in Australia and maybe becoming more relevant with some proposals that the Biden administration is putting out this year. But in Australia, we don't have an estate tax. Is that really true? Not totally, because there's also no step up in basis. So that kind of acts as a certain kind of estate tax, given that that's been inherent in the US system for a very, very long time. In fact, that's one of the changes that they're talking about, is providing $1 million capital gains relief, but no step up in basis on the US side. Let's not get into that right now. Let's talk about Australia and how they define tax residency. So they have the resides test. Do you normally live in Australia? The domicile test. Is this where you presently and forevermore consider calling home? Where do you truly live on Earth, and where do you intend on staying long term? 183-day test if you've been here for more than 6 months. All pretty straightforward. There were some changes proposed in the 2021 21-22 budget to do with definition of tax residency. There'll be more to come on that. But essentially that's it. If you're not a tax resident of Australia, you don't really have to worry about paying Australian income tax on income from overseas, other than, and this brings up another concept, Australian sourced income. So if you don't have an asset that's deemed by its very nature to be taxable in Australia, like real estate, clearly that happens here. The taxable event, the nexus, the connection between the income and the tax is very clearly established in Australia. So those of my longtime listeners and viewers will know I'm not very bullish on the idea of owning Australian investment property overseas for a host of reasons. But that's one of them. You've got to file your Aussie taxes and pay Aussie tax rates, which, oh, by the way, 32.5% from the first dollar are not especially attractive for non-residents. Australian registered businesses, Australian family trusts. That's what you see as Australian sourced income. But here's the beautiful thing. If you're not in Australia and you're earning your money overseas, ATO says, we don't really care. You're not here. You're not enjoying the benefits of all the infrastructure and attributes of civilization that we're providing, so we're not going to tax you. Uncle Sam doesn't see it the same way, however. The remnants of this, of how the US came to have citizenship-based taxations, trace back to the Civil War. And that is, there were thought to be beneficiaries of the outcome of that war that could simply move over to the Caribbean, ride out the war from over there, and then come back and just make sense of the situation that would therefore be the facts on the ground at that point in time. So the US said, we don't care where you go, we're going to tax you on your worldwide income. And that remains in effect to this day. And that's what today's webinar is all about. How do we need to change our investment style because of this US citizenship-based taxation system? So tax residency, I'm not going to bore you and get into detail with this because it's very easy to do that. I try my best to liven things up, but really, if you are an American citizen or a green card holder and you haven't submitted your Form I-407, congratulations, you are a US tax resident. Why? Even if you're not in the US. Why? Because of what I just mentioned, the citizenship-based taxation. So Australia's different. You're not in Australia, they won't tax you other than on Australian sourced income. US, not the same. Doesn't necessarily mean you're going to be double taxed. In fact, that's kind of rare because of tax treaties and tax credits and so on and so forth. But you will be assessed for whether any tax is due. There are other US tax residency tests. Tonight's presentation is not pitched at those folks. That would typically be visa holders in the US that satisfy some other definition. And the major one is a 183-day test, which is a nasty test because you would be, substantial presence test, which is a nasty test because it sounds a lot like the 183-day test that Australia has, but it's not. They actually have a formula that counts back the last couple of years. So even if you're in the US for more than, I think it's 120 days in the current year because of the crediting formula for prior years, congratulations, you'll be a US tax resident in that year as well. So that's no fun. All right, so the reason I'm leading with these definitions of tax residency is because that's the whole point of today's webinar. Tonight's webinar is, if you are a US tax resident, you've got to be mindful of the US tax implications of any income or investment you make anywhere in the world. Okay. What if you are a non-US person? How does merely having been to the US change your investment choices? Well, good news is it doesn't. If you were someone who was in the US on a visa, it's now expired, you've returned back to your home country, you were a green card holder, but you've submitted your successfully submitted, not merely just put it in the mail, but you've received acknowledgement that it was received and processed by the consulate officials, or you were a US citizen but have relinquished your US citizenship. If that is your situation, then really thank you for coming. The webinar here doesn't really affect you because you're not considered a US tax resident. So you can do whatever you want. You just invest in Australian ETFs, managed funds, REITs, limited partnerships, you name it, you can do it. The US isn't really going to impact your financial and investment decisions. However, if on the other hand, you are a US person, and we just went through that, a US tax resident, how does that change your investment choices? Well, it changes it in a pretty profound manner. And why is that? We're going to talk about that on the next slide. So you need to be mindful of, and here's me banging on the table, you need to be mindful of investing in mutual funds, managed funds as they're called outside of the US, ETFs, listed investment companies, REITs, infrastructure companies, to name but a few, that fail what's called the PFIC test. We'll talk about that in just a moment. So why do we need to be mindful? Because if an investment is deemed to be a PFIC, it is bad news. It is very bad news. It means you're going to be taxed at a higher rate, a much higher rate, but worse than that is that they're going to steal your time. They're going to steal your time in what's involved in completing and complying with the reporting of a PFIC. So not only is it time consuming, all the record keeping that's involved, it's costly having to file these in the first place. And for most folks who aren't high net worth, that's actually, or it's possible that that's the bigger cost, is the additional tax filing costs that your tax preparer is going to charge you by virtue of your PFICs. And once a PFIC, always a PFIC. One thing to be mindful of there. So they're nasty. We need to be mindful of that. For that reason, we did put together a white paper. This came out about a year ago on how PFICs simple way of doing it. And in my opinion, that would be investing in individual companies. So individual companies, if you own shares in Telstra, in BHP, in Commonwealth Bank, for instance, if you own them in these companies directly, they are not PFICs. Why? Because they are not investment companies. Telstra exists to provide telecommunication services. BHP exists as a mining company. They happen to produce a return, a dividend, and hopefully their stocks go up over time, but they are not investment companies, unlike a managed fund or an ETF, for instance, which would fail that PFIC test. So really best to avoid these things. Getting into individual stock investment is really the one of, I think, the things that brought people to today's webinar. It's why should we pay any attention to that? Well, because otherwise, if you don't, you've got PFIC status to worry about, and that's a hassle. I can almost guarantee someone's going to say, well, what about my superannuation fund? Are they PFICs in there? Probably not. Probably not, I would say, if it's a retail fund. If you've got your fund at Australian Super and you're choosing from amongst one of a dozen investments or so, you're probably fine because there's an exemption that's carved out there. However, if you had a small APRA fund or if you had a self-managed superannuation fund and you're choosing those investments and you've got much greater discretion over that investment choice, then you may very well have a PFIC in your portfolio. Okay, so let's look here. What's this blue rectangle all about? Relative strengths and weaknesses of the US versus Australia. This slide follows because I've now laid out to you that you've got to be mindful of your investments and where they're taking place in the world if you are considered a US tax resident. So every 2 years, Morningstar produces this this report called the Global Fund Investor Experience Study. And I've reviewed that in prior webinars, so feel free to go check that out. Long and short of it is Australia's pretty good, but the US is number one. And the US is number one for a number of reasons. It has the lowest fund fees, but things not covered in this report, which are very important to investors. Of course, there'll be no trading fees over at Schwab, or very low trading fees at other custodians such as Interactive Brokers, and no platform fees. That's a really significant cost in Australia. So not only are the funds themselves more expensive on average, not every fund everywhere is that necessarily going to be true, but on average, there's still a significant difference of about 0.3%, 0.4% on the funds themselves. Remember, you can't access them anyway without them being a PFIC if you're a US tax resident. So it's kind of out of the question to begin with. But it's important to be reminded that you've got it pretty good with the selection of US funds that you have. Also, US disclosure laws are the best in the world. I enjoy showing clients with the Morningstar database that we have. You can go really detailed on that and see all kinds of things about your fund, not only its performance, what it holds, its ESG ratings, the fund managers themselves, and heavens forbid, even where they went and got their education, if you're interested in that. That happened to be another topic that we produced a white paper on, so you're welcome to go to our website and download that. So opening a brokerage account. So you've listened to this guy who's running a webinar talking about these issues. This has maybe rattled you a little bit, and you say, okay, well, I'm either an American in Australia looking to move, who's already has this issue, or I'm an Aussie thinking about moving back. What should I do with these given concerns? Sorry, let me just go back there. The Aussie dual citizen or permanent resident that hasn't submitted Form I-407. So what should I do? Well, there's a couple things you can do. So on your way out the door, before you leave the US, you may say, well, I'm going to open a brokerage account. I can answer that honestly. If they ask about a US address, I'll just tell them I'm living right here, and complete that information. That's all well and good, and you could do that and honestly, faithfully, and compliantly open that account. But there's another thing we need to be mindful of. FATCA. What is FATCA? Foreign Account Transaction Compliance Act, that came into effect in 2010. Yet again, another one of these nasty rules. Doesn't hit individuals directly. There's some disclosures to be made on your tax returns above a certain amount. But mostly it hits Americans abroad with what it doesn't allow you to do. So FATCA is a rule, a law that came into effect that it affects the institutions as well as the individuals. So this is why, if anyone's tried opening an account overseas, they'll say, are you an American? Why? Because of FATCA. They want to know about that. They've got to report back to the US on any Americans that they have. And excuse me, in some instances, this has meant that, particularly in Europe, I've seen this in the Netherlands, they just won't deal with Americans at all, and that changes things and becomes very difficult. Australia, not quite as restrictive as that, thank goodness. But here's where it hurts: is if you open that account using your US address and then move overseas, depending on the firm, they may notice this. So many people aren't comfortable leaving an old address because 1099s and other valuable shareholder communications may be sent to that address if you're not fully signed up for electronic communication. So there's a problem. But also, if you did go into your brokerage account and said, well, actually, I no longer live on Post Street in San Francisco, I'm now in Melbourne, be that as it may, they'll say, great, thank you, Mr. and Mrs. or Ms. Client. We appreciate that. We're going to restrict your account because we don't allow folks that are overseas to hold our accounts unless you're a high net worth individual, because the reporting is not worth it to us. And that's the issue that you run into there. So we have FATCA to thank for that. I would encourage you, go check out Dr. Karen Alpert's page. She's a lady, a former professor at the University of Queensland, who has a Facebook group called Fix the Treaty that's about addressing these kind of inequities that are inherent in the US system for folks abroad. So very few brokerage firms will open an account using an Australian address, and even fewer would open them for retail investors. So that's something to be mindful of here. Just shifting gears. So what I've said here may have been shocking to you. You must say, oh my goodness, I've got to invest in individual stocks. What a hassle. I don't know if I'm up for that. That's going to be a nightmare to even do. What stocks am I going to buy? How much? Et cetera, et cetera. So here are the two approaches that I've come across with other international and cross-border planners. There are other firms in the US, major firms, in fact, they'll say, that's great, we don't care if you've moved to Austria, Zimbabwe, or anywhere in between. The US has got a great system. Why don't we just keep it really simple and we'll just invest everything in the US? You've got the best investment environment here, the world's reserve currency, known in investment universe and regulation, and it's going to be really simple. Let's just do that. My approach to that, which is not perfect, and I hate bringing up extra complexity, but the fact of the matter is that the big risk is what's called liability mismatch. Liability mismatch. Lots of syllables in that phrase there, liability mismatch. What does it mean? It means if you're living overseas, if you're here in Australia, for instance, and you're incurring your bills in Australian dollars, or you're planning on major investment or personal goals that will be incurred in Australian dollars, namely retirement, buying a house, or sending a kid to college, you have a liability mismatch. What is that? It means essentially you're going to be incurring an expense in one currency while you hold assets in another. Two sides to this. Either the currency appreciates and gains strength. No one's ever called that a problem because congratulations, you've now got more money than what you may have had to budget to meet that particular goal. Again, no one's really going to complain too loudly about that. On the other hand, what happens if the currency weakens? We saw a decade of weakening of the Aussie dollar versus US dollar from 2010 to 2020, changed rather abruptly in March of last year. But for a decade, we saw the Aussie dollar go from $1.11 all the way down to an intraday low of 57 cents in late March of last year. And since then, it's been kind of increasing, but we'll see what. No one knows, where that's headed or what the future holds there. But the trouble that I'm alluding to here is if you have the assets in one currency, you're incurring the bills in the other, that's a big problem. So having your investments spread out between currencies can be very beneficial because it's going to act as a natural hedge on those foreign exchange fluctuations. On the downside, however, it is a hassle to have to do the research to dig up what companies am I going to buy, and then of course there's the matter of trading and rebalancing. So challenges of investing overseas here. Now, I've been thinking about this and I would love to hear your thoughts on this topic. This may well be a webinar unto itself or even a series of webinars, but I'm going to unpack it in 2 slides. Tell me what you think. Should I turn this into a webinar right here about investing abroad, the practicalities of investing abroad as a do-it-yourself investor? First, there's the asset allocation. Most individuals don't pay nearly the attention that they should to their global asset allocation. What do I mean by that? I mean, as someone in Australia with overseas investments, you've got the asset allocation you're exposed to. Thank you, Kylie. You've got the asset allocation that you're exposed to within your Australian investments, within your super, or any after-tax investments, or any real estate that you have. You're already exposed and have an allocation here. And then, of course, you have your exposure on the US side. Are you managing them in tandem? There was foundational research done in the early 1990s, Brin 1991, who showed that most of an investor's return is due to the asset class. It's not the individual stock. I mean, sure, if you pick the best, the winners, then that would do even better. But I mean, why wouldn't you just guess the best, the winning lottery numbers? That would be an even better strategy. No one knows what's going to happen in the future, and anyone that pretends to tell you otherwise, you should hang up the phone, turn off the computer, or not listen to them. So asset allocation, being exposed, being diversified, and being appropriately diversified depending on your risk tolerance and your time frame and your goals. Investment tax. So understanding what the tax situation actually looks like across borders. If you're a tax resident here in Australia, how are your foreign investments going to be taxed? Well, generally, Australia, yet again, has a better tax treatment of foreign investments. Does present an opportunity for those that are going to cease US tax residency, leaving the US, returning to Australia, because Australia views those assets as the fair market value, the taxable basis of those assets, as being what they were on the date that Australian tax residency resumed. Uncle Sam, not so kind. Uncle Sam says, congratulations, if you moved here, we're going to look back 5 years to what you held. And furthermore, we're also going to look at the original basis of whatever asset you own. So that could hurt. If you were a homeowner who's held a home for a long period of time, moved to the US, have a massive gain in Australia, they're going to give you an unlimited primary residence exemption while you're still an Australian tax resident. The US, on the other hand, 250 to 500,000, depending on your tax filing status. So there are some interesting cross-border things we need to be mindful there, quite aside from passive foreign investment corporation rules. Asset location, is that a typo with number 1? No, it's not. Asset location refers to holding the asset in the appropriate country, in the appropriate type of account to get the best tax treatment available for that particular asset class. Best examples of this would be within the US if you own capital gains assets, which for those, currently the Biden administration is proposing a change where if you earn more than $1 million a year, then you pay at the also changed 39.6% marginal rate. But for everyone else, below that, it's about 600,000. Below 600,000 income, your federal rate is about 15%. It's about 15%. I hate to guess it. In fact, my conscience is playing on me there. So I'm going to take a look over here at my handy dandy never leave home without it key financial data sheet and see exactly what that number was. So there it is. Sorry, it's in microscopic writing down there. Above 500,000, $600 is when that 20% capital gains rate kicks in on the US. Let's go back to the action over here. Okay, so asset allocation. So the idea would be you keep your equities in your brokerage account, getting taxed at 15%. Why? Because if you keep it in your 401k, what the government giveth, the government taketh away at retirement, and it's going to be taxed as ordinary income. They gave you an ordinary income deduction for the contribution in the first place. Thank you very much. We'll take that right back from you in retirement. Why would you might therefore ask, well, why would anyone contribute to a 401k in the first place if you end up having to pay ordinary income taxes anyway? And the reason is because during our earning years, we're typically in a higher income bracket than what we are in retirement because we don't have the same amount of money. We're not working, we're living off our assets, incomes tend to be lower. So there's a delta between the two of those tax brackets that still make it attractive. Okay, what do we have here? Next, rebalancing effectively. That is very important, of course, that goes to that point previously about rebalancing. How do you do that if you've got currencies that are fluctuating all over the place, assets held where it's not easy to do research on your Australian holdings, your US holdings? How do you bring it all together? It is indeed very, very challenging. Managing your portfolio through time. Okay, this is a broad point, this one. Managing your portfolio through time. This is all about goal-based investing, and we are practitioners and believers in goal-based investing. What is goal-based investing? It's really predicated on the premise that money exists in service of a goal. You know, is earning a return on a random investment portfolio a good thing? Definitely. I've often thought it's like water. It's a case you have enough. Actually, forget that metaphor. I'll save that for another time. But managing your portfolio through time. So the idea is you identify a particular goal, a time frame, risk tolerance, tax situation, cash flow needed from the portfolio throughout that period, and you invest a sum of money, and then you rebalance it, and then you glide path it. You take your risk off the table at the approach of that particular goal, and therefore your money is most likely to actually be there when you attain that goal. Next, reporting. Really important. In fact, I say to new clients, the most important question is probably one you've never asked yourself when talking about how to measure your portfolio performance. Most people work like this. They take last month's statement, they get this month's statement. Has my balance increased over time? That's how most people do it. Is that the right way? Is that how it should be done? No, it's absolutely not. The most important question, the most significant thing is, have you beaten a passive index that matches your risk tolerance, your time frame, your tax rate, all those things? So we put together custom indexes that do exactly that. And so we're managing to an appropriate benchmark. That way you're able to tell, is someone adding value or not? Okay. Foreign exchange. So we're nearly done here. In executing large, this is, maybe it would have been better if we released these bullet points individually here, but this is a bias. I'm in the business of identifying behavioral biases. There was a Nobel Prize winner, Amos Tversky and Daniel Kahneman, 2011. Daniel Kahneman, who's still alive, he wrote a book. What is it? Thinking Fast and Slow. It was a bestseller. And in this book, he talks about all kinds of behavioral biases. And I think there's a couple more that I could add to it, given my experience in this cross-border world. One of them is to do with foreign exchange and how people make sense of foreign exchange. And it's totally understandable and totally wrong how this bias plays out. The way it works like this, and this is more relevant, say 2 years ago. You can see with my example, you're lucky to get 2.2% anywhere in today's zero-bound interest rate environment. But this is what would happen. People would say, well, gosh, Ashley, I'm moving back to Australia, or I'm moving to the United States. I want to move my $1 million, and I'll need it to buy a house when I get there. But currently, the bank is paying 2.2%, and in the US or in Australia or wherever, they're paying nothing or way less than that. So I'm just going to keep my money here and earn that 2.2%. Thank you very much. Okay, that is fine. Now let's actually look at the volatility. You can see my handy dandy daily FX chart right here. Let's actually look at the volatility of the US dollar exchange rate and see, does it bounce between 2.2% very often? And the answer is, let's take the current rate, 77,845 times 1.02, 795. When did we last hit 795? By gosh, it was a couple months ago. It was a couple of months ago. Now, what about the other side? When did we last hit? I'm doing a 2% reduction in case anyone's wondering the number that I'm doing. 7628. When did we last hit 7628? Well, by golly, look at that yet again. It was within the last 6 months that we did that as well. So the bigger point I'm trying to make in this is that it is a bias to hold on to the certainty of this 2.2% approach as compared with implementing a considered foreign exchange strategy where you can get hopefully, fingers crossed, no guarantees, get a better exchange rate when you need to purchase that particular asset at some point in the future. So this is also taken from a webinar that I did about 2 years ago, how to get the best foreign exchange rate. If you're having trouble sleeping, another great recommendation, check this out. But this would be my recommendation. Be familiar with that rate. What is it doing? What are the drivers? Where's it going? Knowing when you are going to depart the country and suddenly begin incurring expenses in this foreign currency. And then what's the time frame over which you will be drawing down those assets? So maybe you've got retirement, you've got 30, 40 years before you would need to convert all that money back. Form a view, have an opinion, and say, right, I'm going to write this line in the sand and say, I think anything above this rate is a good rate, anything below that is a bad rate, and I'm going to form my strategy based on that. Set up periodic transfers. So you might say every quarter, I'm going to move some percentage of my money back from one currency to the other to dollar cost average and get that average exchange rate rather than the spot price at any point in time. Find the appropriate venue. For our clients, we've negotiated a rate that's 85% less than the next best retail alternative, 10 basis points with a company called AFEX. Other good retail alternatives would include TransferWise and OFX, but they're coming in about 0.6%, so 0.5% more for the for your foreign exchange. Risk management. Now, this is a little bit more avant-garde, but there's such a thing as a forward contract. You can agree on an exchange rate right now for up to 12 months in advance. You can say, right, we're going to change rate at exactly this rate at 12 months from now. A limit order. This is part of my preferred strategy. At the beginning of a quarter, we set up a certain order type, and it's actually 2 orders. So what we'll do is we'll say if it gets above this, then we'll sell. If it gets below that, then we'll sell. And one order cancels the other, because we wouldn't want to see a whipsawing of the exchange rate where suddenly someone sells at the worst possible time and then buys back at an even worse rate, and they've just had a terrible experience. So this order type, one cancels the other, takes care of that. And so what we'll do is set limit orders that only trigger if the trade goes through that level over the course of that 3 months. And we've seen that this results in a better exchange rate experience, especially when done over time. And then options strategies, that gets a little bit more sophisticated as well. Speaking of sophisticated, so there's other issues to worry about on the Australian side with foreign exchange. TOFA really is designed for businesses. We have had some high net worth clients that their accountants have raised this as being a possible concern, but we haven't actually seen anyone getting hit. I'm just mentioning that for your own awareness and research. Where can you learn more about this? Certainly check out our YouTube channel, as you heard me say earlier. I am posing another thing I'd love to get your feedback on would be the idea of starting a community for returning Aussie expats. And instead of this being this echo chamber of ignorance, which is what we see with Facebook, with people that don't know advising other people that don't know, the idea with this community would be it's expert curated, and we're getting real and accurate information conveyed here. So if this sounds, anything I've said here sounds like it might be relevant to you and you want to have a chat, feel free to come check us out here. Click on the Get Started. Be sure to note, who we do our best work with, and we'll be happy to talk. Let me open the floor to Q&A and the chat panel, of course. So there was a question that came in. Let me see that. Why can't I see it? Because my screen is maximized. Using if we move our US investments over when we move back to Australia. Okay, let's see here. So the questions are flooding in all of a sudden. I guess I don't really have a top 3 to recommend to you, because it's going to be dependent on your circumstances and the individual, where you're at presently, what your US personhood status is. Different firms will operate differently. Yeah, it's just very hard to say without knowing your particulars. The next question here is, are US domiciled ETFs traded on the ASX still considered PFICs? Yes, they are. The way to look at that, or to know for sure, it's a difficult one, is to look at what's called the ISIN, ISIN, the securities identifying number. If it begins with a US, you're good. If it doesn't begin with a US, i.e. an AU, then you've got a problem. So to be specific there, if you own some Vanguard fund that was investing in let's say the S&P 500, but it was Australian domicile, Australian issued, it is a PFIC, yes. However, there are some services, I know ComSec has this, where you're able to invest directly in the US. And in that case, you could, in theory, through your ComSec account, own a US domiciled ETF. Where that gets tricky, though, is that you're then paying Australian brokerage rates on a US investment. You'd be better off just having a US brokerage account if you could open it in the first place. It's tough. Cooper, hi Cooper. Can you tell us some more about green card turn-ins? When is the best time to do that? Before leaving? Well, you can't do it before you leave, because then you wouldn't have a legal status in the US. So you'd have to do that afterwards. Really, the domain of an immigration attorney. I work with a couple that I would recommend. But essentially, it's completing that I form 407, submitting it, making sure it's been received, it's been acknowledged that it's been received, and you're done. You're out of the US system once that's happened. Alternatively, you could not do that, and it would be deemed a voluntary abandonment. Not a good idea, because if things change, if you want to go back to the US, then that application may not be looked upon quite so favorably. So really, you want to do that intentionally. Also, you can only be away for, I think it's a maximum of 2 years before it expires anyway. Anonymous attendee writes, based on how the US calculates tax residency differently from how Australia calculates tax residency, I can see that you would come out as both. Yes, that's true, and that's possible. But remember, you can only be a primary tax resident of one country in a given year. So that's what the tax treaty deals with. And there are also tiebreaker provisions in the tax treaty for how to determine your primary tax residency in a given year. But that's exactly right. The other thing not covered here tonight is, depending on what state you're moving from the US, which may be California, or very likely to be a state that charges a state income tax, you need to consider the state residency rules of where you're coming from. So California is not known to be very nice when it comes to this. They apply a very similar definition as to what the US federal government applies. And that is, they say, if you're anywhere in the world and your domicile remains California, then Governor Newsom is going to be asking for his 9.3% for most people, a little more than that for higher income earners, for their fair share as well. So you've got to be mindful of US state tax issues as well as the federal tax as well, but do be mindful that the tax treaty does come into it to avoid double taxation. In fact, that's what it's called, is the double taxation treaty. Next, anonymous attendee writes, regarding managing exchange risk, what do you think about investing in Australian index funds that track the Australian market indices via US investment firms such as Schwab? These investments would be made in US dollars, so would avoid PFIC status. But do these investments protect against exchange risk to some degree? What a great question. Wow, what a great question. I'm going to just read it over again. Okay, managing exchange risk. What do you think about investing in Australian index funds that track the Australian market indices via US? Okay, so it sounds like you're talking about an Australian index fund, if I would hazard a guess there on that one. If it's an Australian index, Aussie market indices via US investment funds, well, so that would be true, anonymous Mr. or Mrs. or Ms. Anonymous here. That would be true in that it is tracking Australian market indices through a US ETF. Let me, about investing in Australian index. So what I think you're saying is a US issued domiciled index fund trading on Schwab that tracks Australian companies. Well, bad news, doesn't exist. To my knowledge, it doesn't exist. There are some broad Pacific area ETFs, but not one that does exactly what you're talking about. The other thing is that it doesn't necessarily deal with the foreign exchange issue if you're located in Australia, because it's denominating it back to US dollars. Are there other foreign exchange hedged products out there in other asset classes? Yes, there are. Vanguard, in fact, offers some, but not the product you're describing, which would be very helpful. That, to my knowledge, it doesn't exist. Okay. Next question, if I am a US citizen but have Australian permanent residency, will I be negatively impacted if I apply for citizenship if I make over 100? What a very specific question. Sounds like there's something there on your mind that I'm not aware of. I wouldn't think it would impact anything because you're already an Australian tax resident. You're already a US tax resident by virtue of being a US citizen. So would you be any further negatively impacted if I apply for citizenship if I make over? Not that I'm aware of. There's maybe something attached to that number. I haven't heard of 107,000 before as being a magic. Oh, I know what you're thinking. Foreign earned income exclusion. Would I be negatively impacted? No, you wouldn't be. Okay, that's what you're talking about. $107,600 foreign earned income exclusion. Would you be negatively impacted? No, because the Australian federal rates are higher than the US rates. Therefore, the foreign tax credit would make up for that. You would not pay double tax. Colin Green. Hi, Colin. Good to see you again. There has been increased discussion and worry about inflation recently. Yes, there has. This is true. If our short-term goals, i.e. less than a year, is to purchase a home in Australia, what is a good investment for these funds? Australian cash or other short-term investments? Wow. Okay. So firstly, we need to be mindful about investment recommendations in a public setting. We'd never do that. But what I could share here is to say that for any client of mine with a goal of less than 3 years, where we're introducing significant risk by investing, because remember, whenever anything is invested ever anywhere, it is subject to risk. And so if you're talking about funding a goal in the short term, I would not consider investing it. But then again, looking at this iShares ETF you're talking about, which tracks the Australian market, I'm going to have to guess that that's Australian issued because, as I said earlier, I'm not aware of anything that's US issued that tracks the Australian market. If it is, send it to me. I'd love to know about it. I look at that every 6 months. Last time I looked at it was a couple months ago, and I found exactly nothing that was US issued that did exactly that. Ian, let me otherwise address this other point about inflation. I just had a client meeting this morning and I spoke about this. The best commentary I've heard about this increased inflation, which is separate from your other concern here, and that is purchasing a home. That's a different concern altogether. So inflation is the topic du jour of economic commentators. The best commentary I've heard is to say that, in fact, what we're experiencing is rebound inflation. So this is the inflation that has come about because the bars have been closed, because the travel industry has been closed. So now that they're opening up again, the embedded inflation that they've had with the cost of their energy, their insurance, their other inputs, wages having gone up over the past year hasn't been expressed in the inflation data in the first place. And so now that we're opening back up, we're seeing a bit of a pump. Of course, the bigger fear is that with the magnitude of the stimulus that the Biden administration is talking about injecting into the US economy, that's going to trigger real significant inflation. And I think it's another one of these behavioral biases that people have. It's to do with Weimar Republic or Zimbabwe style hyperinflation versus inflation going from 1% to 3 or 4% for a quarter or a half year. Is it a significant factor? I don't believe it is. However, your other issue here is buying a house. Now, is inflation a factor? That price inflation is absolutely a factor. Is now the right time to buy before you go back? I have no idea. I don't know where you're talking about moving to or anything else that's particular to your goal there. But yeah, absolutely. Prices have increased to my knowledge, the fastest rate on record this year. So that is a concern. But conversely, you need to be mindful of all of the moving parts here. What's happened to the exchange rate with the move you're talking about back from the US to Australia? Thankfully, that's gone in your favor too. And the stock market has also gone in your favor. So like I said, no specific investment recommendations. We do not ever do that for non-clients. But short-term goals and funding of short-term goals, you're taking a big risk if you were to invest at all. Ian, hi Ian. For tax residency rules, does the given year refer to the US financial year or the Australian financial year? It's actually the calendar year, so it's not really and it gets more complicated, of course, because of that mismatch that you're alluding to there. So in the current tax year of the country that you're in, you would need to be looking at the rules of that particular country and how they determine tax residency. It's actually tax residency. It's seemingly so simple, and it is for 99% of people. In my case, actually, it's anything but straightforward. And then there's your business. Where's the residency of your business in a given year? If you're doing a move such as I've done, where I've relocated with my family back to Australia for 18 months, it gets very, very complicated. So for each individual tax year of the given country, you need to look at and see, where would you be a primary tax resident of? And I think, by the way, I really want to congratulate you all for attending the webinar. This is not me saying goodbye. This is a couple more questions. Because when you talk to a CPA, it's like being an informed patient before undergoing some kind of procedure. The more informed you are, the better results you're going to get. And that's what this is right here. So if you know the various things that feed into determining your tax residency, then you can push back and maybe get a better outcome by informing your tax preparer of what the situation truly is. Hi, Sam. I'm not Cooper, by the way. Can you share some strategies on dealing with the green card turn-in exit tax? Does it make sense to avoid realizing capital gains in Australia until after the green card has been turned in? Should I wait until the end of the tax year in addition? That's a great question. And we have actually run a webinar on this in the past, the HEART Act, the Heroes Earnings and Repatriation Tax Act of 2008. How do you become a covered expat? You fail one of 3 tests. Most people fail the global net worth greater than $2 million, $2 million US. Would you be smarter to realize capital gains? Maybe. I mean, probably, but I'm not, like I said, don't give any personal recommendations here. Why? Because in that exit tax, the way it's calculated, they give you a $750,000 US exemption. So you can have realized gains of that much before you would have to pay US capital gains on that. But it just depends on so much. It's hard to say. I've seen this. Okay, EWA. I'll get back to you on whether EWA is in fact an Australian tracking ETF available on Schwab. It sounds wonderful, and if it is, then I'll be sure to mention that. All right, that brings us to a close. The question stream seems to have died down a little bit. I'm going to guess that everyone's had a chance now in the past 10 or 15 minutes now to get those questions answered. So I'm going to say thank you, and we'll look forward to seeing you all next. Oh, never heard back on some of those questions I asked about a social media group or interest in a webinar where we do a deeper dive on the investment related issues. But do please take a minute, fill out that post-webinar survey, and we'll look forward to seeing you all next month. Be well.